Ladies and gentlemen, I'm Khaled and I will be your host for this session. Good afternoon and welcome to our WebEx session, Fintech and Financial Inclusion, Navigating Regulatory Issue. The session is presented by Chopra, Saumya Ramakrishnan and Mr. Tushar Aggarwal. Please note that this session will be in listen-only mode and will last for 60 minutes. Be spent on panel discussion. The remaining time will be available for the Q&A. Requesting all the participants to be on the mute mode for the session. You can post your questions in the chat window while the panel discussion is on. The moderator will queue up the questions for the speakers accordingly. Should you need any assistance during the conference call, you can use the chat option. Do note that this conference is now being recorded. I now welcome our session presenter, Pratibha Jain, who heads our Delhi office, Kamath, leader TMT practice, Riya Chopra, member of Dispute Resolution and Investigations practice, Saumya Ramakrishnan, senior member, Private Equity and M&A practice. We also have with Mr. Tushar Aggarwal, founder and CEO of StashFin, a digital consumer lending company. Over to you, Pratibha.
Thanks, Khaled. Thank you, everyone, for joining us today for an important webinar. I think the current crisis has enhanced the need for us to have an urgent discussion on this topic. If people would have seen, the Prime Minister has provided 500 rupees to all women who have a Jan Dhan account with which has been opened up. Imagine if that account, then people have to go in these circumstances to the bank to withdraw the money. Fintech provides you the opportunity, more so in a crisis like this, to be able to access finances and do financial transactions without having to physically go to a bank or physically enter into transactions with counterparties. The more, especially for a country of size like India, the more penetration we can have for the fintech industry, the more it's going to help in programs that the government has been announcing, and will help in the future as we try and recover from the current crisis. The importance of fintech industry being able to provide solutions for financial inclusion is going to increase manifold. The Indian economy has responded well to the fintech opportunity. I think primarily it's currently being driven by the penetration of smartphones in India, the surge in e-commerce, government initiatives such as UPI, Digital India, of course, the Jan Dhan Yojana, which has helped in increasing not only banking penetration, but knowledge, some amount of financial literacy in here to underserved bank areas. I think the underpinning of how important fintech is has been stated by RBI Governor himself, who has said that the potential to reshape the financial services and financial inclusion landscape in India, fintech has a tremendous way to go in this regard. It can reduce costs and improve access and quality of financial services. This recognition by the RBI governor himself and a steering committee that was set up by the government, which provided its report in 2019, had laid down various measures that the government needs to take to promote the fintech industry in India, and also laid down all the initiatives that are already there and how successful they have been. We're going to take this discussion today one step forward from there and talk about what has already been done, starting basically with what is fintech and what is fintech in India, what products we have already seen. We have today with us Tushar, who is working in the space in providing online lending. So we'll get his views on how successful such initiatives have been and what more needs to be done. And then we will close on summarizing some of the regulatory issues and some of the other issues that we can suggest to the government in terms of taking forward and helping deepening the fintech industry in India. With that brief introduction, I'm going to invite Saumya to talk about the various fintech models and the regulations regarding them in India today. Saumya, over to you.
Pratibha. Yeah, good afternoon, everyone. We appreciate you taking out time to join us on this important discussion, like Pratibha pointed out. So, when it comes to laws around fintech, the real boom happened between 2007 and 10 when we saw a huge rise in the payment space and we got the Payment and Settlement System Act, which till date remains one of the most sophisticated legislations in India in the fintech space. And also in similar space, we had the establishment of National Payment Corporation of India. And since then, it's only been going upwards in terms of legislation in India. However, in a bit, we'll talk about whether it has been sufficient, whether there are any loopholes. But coming back to the question on what are the various types of fintech models, honestly, the way things are right now, the sky is the limit. We've had payment gateways, we have digital wallets, we have digital lending, which is one of the things we are going to focus on today. We have insurtech, we have tech companies which provide financial services, we have alternative credit scoring mechanism, insurance underwriting mechanisms, etc. And as we speak, there are more and more innovations and business models being developed. And like I said, since we are focusing on digital lending, um, to just discuss one of the most common models that we see in a digital lending space, because that will also help us understand the regulations better, is there'll be a customer and a borrower, like in a traditional lending space. Usually there is also a tech company in between. Sometimes the tech company is also the NBFC or the bank which is providing the lending services. Then there are payment gateways, which sort of help with the cash flow between the borrower and customers. Then there are also certain credit information companies in the whole business model, and there are also outsourcing service providers. So as you can see, there are a lot of participants involved in one simple fintech transaction, and hence, till now, fintech is not under one umbrella of legislation in India. It is scattered in that sense. There are sectoral regulators like IRDA when it comes to insurance, SEBI when it comes to any sort of innovation in the securities market, and then there is RBI pretty much regulating all sorts of financial activities. And then you on the sidelines have your data protection laws, you have your consumer protection laws, Prevention of Money Laundering Act. So it's sort of a complicated regulatory space where all these laws have to be read together, and hence compliance becomes a little difficult. So to take this discussion forward, so one of the key areas in digital lending that has developed in the last 3 to 4 years has been the peer-to-peer lending platform. So the RBI has come up with lending guidelines for P2P lenders a few years back. Now, just to put things in perspective, what is really a peer-to-peer lending platform? Are they lenders? Not really. So they are basically an intermediary and online, website operator who bring borrowers and lenders together. And the whole genesis of this model has been that there are a lot of high net worth individuals and retail investors who are not necessarily financial institutions but have the appetite to lend to borrowers in need. Hence, there had to be a separate framework for them. And there was initially a lot of confusion on whether technology service providers who help bank source customers will qualify as P2P. While the regulations don't clarify that, through an FAQ, the RBI has clarified that if a service provider is only guiding or assisting a bank or financial institution to source customers, they'll not be a P2P lender. And requirements here are that a P2P lender can only be a company. Then there is a net own fund requirement of 2 crores, and there are also certain do's and don'ts for P2P lenders. Basically, that it cannot cross sell, it cannot lend from its own books, it cannot service any secured loans, and it cannot provide any credit performance or guarantee. And also, there are also exposures which are given for borrowers and lenders. Again, because these are not envisaged to be sophisticated borrowers and lenders, the RBI deemed it necessary to sort of regulate even to the extent of how much they can borrow and how much they can lend. And also in terms of data, NBFC P2Ps are also required to become members of credit information companies, because that's the only way they'll be able to access data and do their sort of risk analysis. And also because this business is envisaged to be primarily IT driven, there are also a lot of disclosure requirements when it comes to your scoring methodology and what your business model is, which some of which have been a point of concern for some of the industry players, which we'll be discussing a little later once we've discussed all the regulation as to what we think the major issues are. Now, so this is pretty much the law as of today, which covers technology service providers connecting borrowers and lenders. So the other aspect which I spoke about, when I was explaining the business model, was a credit information company. Now, on similar lines, we have another concept called account aggregator NBFC. Again, this is a subcategory of NBFC, just like the P2P lending. Account aggregation is nothing other than just retrieving and collecting financial information pertaining to customers. And where your IP comes into the picture is you use that data to do an analysis and present it in such a way for the banks and other regulated financial entities that it makes their own risk assessment and determination of credit limit much easier. And just like how we discussed for P2P lending, they have leverage ratio requirements, they have disclosure requirements almost which are similar to that of P2P. Now, considering all of the above, we also have the Credit Information Companies Act. This is not a fintech specific law. This law has been around for a while, and it basically says that any company which intends to do the business of credit information needs a registration from the RBI. So basically, again, this has been a little contentious because uh, most of the innovative business models that are coming up, really their differentiating factor is the way in which they do the risk assessment. And even from receiving FDI perspective or from a compliance perspective, the credit information companies are subject to a pretty high threshold of compliance. Other than this, there is also, if I have to discuss insurance, there is this whole area of insurance tech as we call it. Unlike digital lending, there have not been too many sophisticated legislations in India around this. We do have the web aggregator guidelines, which the IRDA has come out with, basically which governs the websites which collate information about different insurance products and how those are offered to the consumers. Like we are all aware, since insurance is highly regulated, even for web aggregators, it's no different. They are basically regulated as intermediaries, insurance intermediaries, and there is a lot of compliance relating to how much commission you can earn, what is the renewal commission, and what is the ticket size, etc. A lot of which have been relaxed in the recent past, but very highly regulated nevertheless. Other than this, from an insurance perspective and also from an RBI perspective, to sort of test all these innovative products in the market, the government, both RBI and IRDA have come out with sandbox programs, which we'll be discussing in more detail later in the session. Pratibha?
Thanks, Saumya. Let me bring in Tushar at this point so we can get a bit of an industry perspective. Tushar, if you can just walk us through, what StashFin does and how has technology helped transform, and what is the business case for the online lending that you do?
Happy to, and thanks for having me. Look, quickly by way of background, after spending nearly a decade in private equity and investment banking, I moved over to start my entrepreneurial journey about 3.5 years ago. StashFin is a consumer lending platform. We are regulated by RBI, and we connect borrowers to lend money from our own book, as well as also work with the marketplace of banks and NBFCs in helping borrowers identify credit at the lowest cost possible on a risk-adjusted basis. What we do for a living is that we offer a line of credit to our borrowers, which allow them to take out cash or use our product across any ATM across the country for free through use of a prepaid card. And unlike banks where they will be required to pay interest on unutilized funds, because the line of credit, they can borrow money instantaneously, real time, 24/7, without paying any extra fee or any annual charges. What we found was that the a bulk of solutions which were addressed by banks or NBFCs were largely the tier one markets, where merchants as well as consumers were able to accept electronic forms of payments. But especially in the sort of unorganized market, where let's say someone is buying something in Crawford Road, or someone buying something in Lajpat Nagar from people from Delhi, most merchants will not be able to offer a EMI a solution to consumers for their products. So what we do is we lend through a prepaid card, which allows people to either take out cash, or they can, once they have the funds loaded in the card, they can also take out, use the card across any ATM or POS machine. So we sort of straddle across the payments sort of networks, also the lending networks, because we are an NBFC ourselves. And then we work with a host of banking participants in order to both transmit money to our borrowers through the bank's PPI licenses, which could be linked with Visa or MasterCard, and also use the payments network to receive money back from our borrowers. But look, the business case or the business opportunity, which people might be familiar with because it's been discussed a few times over, would be broadly in 2 or 3 different categories. One category is SME or micro SME lending, which is not a segment we focus on, where, as the name suggests, people who are running a business can access funds from various fintech providers or banks in order to meet their working capital needs or other short-term needs. We find that business model typically requires a very high degree of duration, and therefore that is not a business model we are pursuing for ourselves. The second category of lending is to consumers, which also has 2 sort of broad subsegments. One of them is purchase financing, where there is a point of sale solution provided by a bank, NBFC, or a fintech provider, where someone goes and buys something from a store. There's an option to kind of make the payment, pay the payment a little later, because there's an integration with the point of sale terminal with the provider. So example would be someone buys a cell phone from a store, that will be kind of point of sale integration. And the third area is what we focus on, which is open market lending, which is our set of consumers we lend to are not affiliated with any one manufacturer or one product. We source them directly through online and offline means, and they're also able to use the cash or the money they get from our product universally across any medium which I described earlier. To answer your question, Pratibha, there are the biggest sort of market opportunity is that of the 1.3 or 1.2 billion Indians, there are about 700 million working adults, and only about 300 million in the best case have a bureau imprint, which means that there is a wide swath of people for a variety of reasons, either because of income or because of risk, or because they are located in an area where banks and NBFCs don't have branches, do not have access to the formal credit system. And that really is an opportunity which we are very excited about, and are focusing on our efforts to design a product solutions to cater to that demand. I think you're on mute.
Sorry. That's amazing, Tushar. I think that's exactly the kind of innovative use of technology that even the committee on Fintech set up by Ministry of Finance and RBI has been talking about to serve people who don't have a credit history, who don't have access to bank accounts. But just quickly, if you can also comment on what do you then need for more of such, for you to be able to grow this business, and for more of such innovative business models to come about to serve these sectors in India, and talk not just tier 2, tier 3 cities, but how do you then go even further in terms of financial inclusion?
Sure. Look, I think I'll answer this question both on the supply side and the demand side. I'll take the demand side first. Like I said, when you go sort of beyond the tier 1, tier 2 cities, both the product fitment as well as the product need, as well as the risk characteristics of the borrowers change dramatically. For example, someone underwriting a person in the tier 1 city could use perhaps traditional bureau scores or bank statements to gauge income, or perhaps have an asset ownership test based on how much property they own or jewelry they own, or I don't know what kind of vehicles they own. But that is not a model which can be applied perhaps which is in the hinterland or perhaps upcountry, because a number of our borrowers, a number of the segments we serve particularly, will not meet the criteria laid out by the banks, both in terms of bureau reporting because they don't have access to bureau, or may not have a regular cash flow profile in a bank account because they may get paid in cash. So I think for participants like us, in order to fully utilize the potential of borrowers available, it's important for us to access alternative sources of data, which are beyond the banking as well as the credit bureau data available, which are currently available. Some of the data sources are utility data. So most people may not have a bank account, but they'll be paying some kind of a gas bill, electric bill, or some kind of a bill. It's unclear at the moment with the customer's consent if fintech companies like ourselves, which are regulated, can access the data in a secure manner. And most discoms tend to have their own rules on what they make available to a third-party portal or not. The second set of data, which can really aid us in making a better decision in terms of credit risk underwriting, would be perhaps databases like the GST data or the customs data, with the user's consent, of course. Whether or not we can access the data is also a question mark, because it's...
You're talking about all anonymized data, right? Data that cannot identify a particular individual.
Yeah, so I think I'm talking about two sets of data. One of it is anonymized, which can help in building out better risk scoring models. The second part is user given data, user access data, where user gives consent to access the data on their behalf. And what may seem like a trivial problem, where why can't someone just upload a PDF copy of their utility statement? That is not what I'm talking about, because in that case, we would not know, for example, if that bill is authentic or not. So an integration with the utility provider where the user gives access and then the bill or the statement comes directly from the utility company to the hands of fintech is what I'm describing as a solution. Other sets of data, which I think we also utilize in the case of the demand side, we're also looking to partner with banks, would be areas where we could work with banks in terms of co-branding, or also defining some sort of a schedule of charges or fees, where if a fintech would get a customer to a bank, what would be the role the bank would play, what would be the ownership of the customer, and how that relationship will be managed. So those, I would say, would be sort of the demand sort of side problems to be solved, which is data access, regulation, as well as partnerships. On the supply side, as you may imagine, the country is relatively capital starved, especially after the IL&FS crisis. The biggest market for NBFC type loans, the CP market, completely shut down, and therefore a supply of capital has been a key constraint or a key impediment for growth for a number of players like ourselves, and also other large banks and NBFCs. There have been some relaxation norms in terms of tapping foreign credit, especially ECB borrowing norms. But at the moment, the present regulations, which have a rate cap as well as a tenor, maximum tenor or minimum tenor, those pretty much make it impossible for fintech companies to access those markets in a meaningful manner. So I think supply side and changes in both accessing capital markets would also be very important to penetrate more financial inclusion in the country through fintech.
Yeah, absolutely. In fact, the supply side issue has come up in, a couple of our other webinars because fact is today there is the debt market in India is, especially for supply side for NBFCs, right? There's just no liquidity. And unless you get those wheels churning, and we know global liquidity was there even post pre-crisis. So, whether easing of the ECB norms or the FDI norms, like whatever we need to do, or even FCRA, right? Like even if foundations can provide funding for some of these products, which will help broaden financial inclusion in India. I think those regulatory changes are the need of the hour. I think that's something that the government will have to look at immediately. Let me just bring in Aaron and Saumya back in terms of just discussing what are we as lawyers seeing some of the other regulatory issues with respect to some of the other fintech products in the market.
Sure. Thanks, Pratibha. Saumya, if you don't mind, maybe I'll start and hand over some points to you after, and you can substantiate and add more value on those points, I'm sure. But Pratibha, yes, there are a lot of benefits that fintech has on financial inclusion. Tushar was speaking on some of the practical points on ground. From a legal standpoint, from a regulatory standpoint, what we've seen in the regulations, what we've seen in RBI committee reports, and what we've seen in RBI committee surveys and analysis is quite profound, especially in the last 2-3 years. For instance, in credit scores, especially in the online, the micro credit facility, digital lending space, generating credit scores, now appears seamless. Customer onboarding, customer registration, has been helped with this through the use of online aggregators, and we'll come to aggregators in a bit. It has its own set of issues as well, but aggregators have definitely helped in the overall process of onboarding customers for distribution of loans and the like. You have outsourcing partners to whom eKYC has been or is being outsourced to, not co-functions but facilitation services. That has helped a lot. Even today, even banks and NBFCs to a large extent are making use of such outsourcing partners for eKYC. On the RegTech front, RegTech is something we have heard a lot in the last 2 or 3 years. It is essentially the effective performance or the effective delivery of regulatory requirements via technology. For instance, you have the digital locker. The digital locker has picked up a lot in the last year, especially post Aadhaar, post certain KYC developments, and helping comply with them. So you essentially have an online locker where you show a valid document stored in that locker, and it helps you comply with certain KYC requirements. Also filling in forms online. So RegTech has definitely helped in compliances. So all of us, or at least most of us, have a mobile or a banking, a fintech app on our phones today. A lot of us have digital bank accounts. We may have other forms of fintech facilities like e-wallets, UPI, and all of that. So this has helped overall in financial inclusion for all of us, and also in tier 2, tier 3 cities, rural areas as well. Today, I mean, you spoke about internet penetration as well. The volume of internet usage and smartphone users is a lot, and hence, for instance, you have the 811 banking account which Kotak offers. So that even banks have started pure digital, pure play accounts. You have payment banks helping in small savings with minimal compliances. Again, at least aimed to be a pure digital process. The last, what I want to touch upon is also BBPS, and all of us in a way make use of BBPS. Most of us, I hope, it's essentially the Bharat bill pay system. It helps pay municipality, electricity, utility bills. You have agent institutions and agents um, which are deployed by certain regulated entities, and that essentially helps. So, gone are the days where you need to do a standing instruction from a bank, or you need to go to your electricity service provider and pay over the counter. So, fintech has helped in all of these aspects of day-to-day life: digital bank accounts, small-time credit facilities, KYC, bill payments, and the like. There are certain issues which also come up with this. For instance, especially fintech, on the fintech side. Not I'm not going on the banking side. I'm talking more on the innovation, the fintech side of it. RBI has traditionally had a conservative approach in um, or appear to have in regulating technology providers. Um, there have been reports and recommendations saying that uh, for tech providers, for instance, insurance aggregators, lending marketplaces, lending account providers who don't, per se deal with money or lend money or provide insurance policies, a light touch regulation has been recommended by working committees. Whether or not this has come into play is one to argue. Tushar can add more perspective on how it's being implemented and the kind of hurdles that maybe account aggregators and P2B lending platforms have to incur, because they do seem, at least in terms of regulation, equated to NBFCs in terms of eligibility criteria, capital requirements, and other compliances, in spite of not being able to actually conduct the activities of a financial institution, and lend money or deal with money. Um, Another, for instance, is also where you have multiple regulators today. And this is purely from a legal standpoint. For instance, you have an insurance aggregator that provides quotes and links to third-party, insurance issuers. That itself, that kind of aggregator, could be subject to RBI regulations, IRDI regulations, MeitY, and the information technology laws. And so, there is an overlap and a diversity and multiplicity of regulations and regulators that also apply. Um, so these are the kind of some of the legal regulatory hurdles that we see. Of course, then you have on the KYC front, Saumya, if I can ask you to throw more light on the KYC, which I know has been a big deal in the last couple of years.
Sure, Aaron, thank you. Um, like Aaron pointed out, and as mentioned by Tushar earlier, I think because KYC is such a critical aspect of fintech, because whether you're doing insurance or whether you're doing digital lending or anything to do with credit, some form of KYC is always essential. So this, you can say, is pretty much the heart of the entire fintech industry. And any kind of innovation and for a product to be successful in the market, it is very essential for the KYC process to be cost effective and time efficient, which is what the innovation has been focusing on. And also the regulators have been making attempts to sort of balance the industry stakeholders' interest and also consumer interest. So as far as KYC is concerned, we can really call it the pre-Aadhaar judgment era and what happened after that. So ever since the growth of fintech in India and before the Aadhaar judgment came out in 2018, most of the fintech companies were doing a paperless KYC using the authentication and e-KYC facilities under the Aadhaar regulations. And it had almost become the norm. Most of the market players were using some form of version of that kind of KYC, which made KYC very, very quick and very, very cost effective. What the Aadhaar judgment changed, however, is that the private corporate bodies could no longer use this sort of authentication for their transactions. So what in effect happened was that Section 57, which is the relevant provision of the Aadhaar Act, was read down to say that this should not be permissible as because it is disproportionate to the mischief that they are trying to correct for public interest. So after the judgment came out, of course, there was a lot of upheaval in the market, and the entire industry came into a huddle, and there were discussions on what is going to be the way forward because a lot of business models were exposed. They wouldn't be able to do the business in the same manner anymore, which would also result in increased cost being passed on to the customer. So after a bit of a wait, the Prevention of Money Laundering Act and subsequently the KYC directions of the RBI were also amended to sort of figure out a middle ground for using some form of Aadhaar authentication for KYC. So what the regulations, the KYC directions now say is that proof of possession of Aadhaar will be considered an officially valid document, which is, to put it simply, that if a person can prove that they are in possession of an Aadhaar number, then without revealing the Aadhaar number, there are mechanisms to sort of do a KYC. So how this is done is either through an online mode or offline mode. Offline mode is again, governed under the Aadhaar regulations where, you have the QR code mechanism or an Excel sheet file verification where your Aadhaar number is retracted. Or the other way of doing it is through the digital KYC mechanism, which is one of the points I'll be discussing under the KYC directions. And the KYC directions have also introduced a concept of video customer identification process. So just to quickly take you through what these processes are very, very detailed, but just to sort of summarize, what the digital KYC does is that the regulated entity, which is your banks, NBFCs, and a few other recognized entities, have to develop an app and with restricted usage, and they need to also have customer touch points. In effect, what happens is the customer has to go to the office of the regulated entity or vice versa and carry the original documents, and a photographic KYC process happens through the officer of the regulated entity. On the contrary, the video customer identification process is a completely non-face-to-face sort of interface. However, again, there are some key requirements there. For example, that the video call should be triggered from the domain of only the regulated entity, and it has to be performed by a bank official, etc. So this is broadly the framework through which the RBI tried to fix the issue of providing increased facility to the regulated entity, at the same time ensuring that Aadhaar number is not unnecessarily revealed to body corporates who may be able to use the data for other purposes. Now coming to what really the issues could be of these revised norms. One is that the request or the requirement of the stakeholders was really to do away with the face-to-face KYC requirement, which the digital KYC has not been able to limit because the customer still has to come to the office or vice versa. So the requirement for non-face-to-face hasn't happened as far as digital KYC is concerned. As far as video KYC is concerned, of course, it's non-face-to-face, but that has its own challenges because the guidelines are very specific on how the app needs to be developed, who can use it, what sort of features should be there in the app, for example, geotagging, etc. So when we've been working with NBFCs, the common response that we are getting is that we are not ready for this, and they require a lot of time and investment in terms of infrastructure and also for training their employees to comply with these new guidelines. And one of the other key issues, like Aaron also pointed out, is this whole outsourcing issue, because right now, like how I explained some of the business models that are being used right now, one of the models right now is there is a technology service provider, which could be a third party or any other group entity or the bank itself, which is okay. But when it's a third party or another group company, then this whole outsourcing thing comes into the picture, because core functions cannot be outsourced. And also for all these KYC processes, RBI is very clear in stating that these actions have to be performed by a bank official. In some cases, they are also given permission to business correspondents to do it. So these are some of the broad issues in the KYC regime. Pratibha?
Thanks, Saumya. So we are aware of the issues, and they're not. Some of them are not that different from what's happening in the rest of the world. Obviously, given the nature of fintech, it's just use of technology for various financial services, and to the extent that you have multiple regulators regulating those services, it is expected that they will then regulate the activity related to fintech in that sector. However, I think what exacerbates the problem in India is that we tend to be more overregulated, especially in financial services, especially wherever there is a consumer touch. I think one of the solutions that, with respect to the problem of overregulation and multiple regulators, that has been provided by the industry has been to see if we can create regulatory sandboxes. Riya, can you talk about the success and how these regulatory sandboxes are working?
Good afternoon, everyone. Thanks, Pratibha. As Pratibha rightly pointed out, that the regulators in India have come up with regulatory sandboxes. The RBI, IRDAI, and SEBI, all three of them have come up with regulatory sandboxes. But for the purposes of this session, we will be focusing on RBI and IRDAI sandbox. Now, what really is a regulatory sandbox? It is a regulatory controlled environment in which innovators can test their innovation, their products and services for a limited period of time, for a limited purpose, which they have to inform the regulator about. And then through that period, with the oversight of the regulator and with certain regulatory relaxations that the regulator may provide to them, they test their product, and ultimately the regulator will go ahead whether the product is viable to be released in the larger market or not. If yes, then yes, they go ahead and launch the product, and then all extant regulations will continue applying on them. If not, then they are not allowed to be released in the market. Now, what are the kind of products that really end up applying for regulatory sandbox? So, for example, RBI came up with its enabling framework last year in August, and IRDAI had come up with its sandbox regulations in July 2019. So I'll take IRDAI first, because they have already gone ahead with the process of screening the applications, and in January and then April, they have also released a list of all selected products and services which will now be launched in the market for the process of regulatory sandbox. So what the regulation really says is that products in the category of insurance solicitation and distribution, underwriting insurance policies, servicing of claims, and certain other insurance products could be tested through this sandbox mechanism for a period of 6 months, with strong oversight of the IRDAI and the SPOC, which is a single point contact that is being set up under this regulatory sandbox, which will be monitoring the progress and everything of this product. And these products are mainly products that either do not have a regulatory framework in place, or enabling some sort of a relaxation will enable this product. And this product is likely to really create a significant impact in helping the consumers penetrating insurance further in the market, or improving financial inclusion. So all these kind of factors have provided impetus to the government to say that yes, we want to experiment, but not at the cost of causing any harm to our consumers and the public at large and public money. And therefore this regulatory sandbox mechanism, which has been tried and tested in various other developed jurisdictions, has been brought to India. Now, the IRDAI, you'll be surprised to know that the fintech innovations have been on top of their game in the recent press releases. So wearable technologies, for example. So today, if I am a person with a certain precondition, I have diabetes, but the insurer will provide me with a wearable device or an app, which will be able to track my sugar levels and my fitness level, and therefore my co-payment rate may go down. Similarly, pay and use and floater motor insurances have come about, and the IRDAI has approved these plans. Pratibha, you're saying something? So the IRDAI has approved these applications under the sandbox. For example, if I have 3 cars and I do not need to purchase 3 different insurances or motor insurance for 3 cars, I may purchase one and I will pay only as for the use of each car. So the IRDAI is experimenting. It is allowing such applications. It is yet to be seen how these impact and how they really play out in the market. And similarly, RBI's enabling framework provides for a 27-week screening and testing window where you make an application, it is tested, and then it is either accepted or not accepted. Once it is accepted, you go through the whole testing phase of 12 weeks. You may take an extension, RBI may grant it on certain grounds. And then finally, if the product is viable to be released in the larger market, it goes ahead. But there are certain conditions that the RBI's regulatory sandbox imposes, which are very critical and important, such as net worth requirement of 25 lakh rupees, the fact that you have to be a company registered in India or a financial institution under any statute in India, or a bank that is licensed to operate in India. Further, insurance adequacy for all of these companies is very important because they are going to be handing out products to the consumers which may or may not be there in the next 6 months or so. So insurance adequacy for any kind of loss that is caused to the customers has to be taken, and that is a requirement prescribed under the RBI's enabling framework and regulatory sandbox. So the applications have been made under RBI sandbox under the first cohort, which is for retail payments. So there are various categories. There is retail payments, there are applications for blockchain, there are money lending services, digital KYC, all these kind of, the spectrum of services can go under the sandbox, make their application, and then, of course, the RBI is going to exercise oversight and see. And what is very important to note is that the RBI in this way is going to be able to gather empirical evidence to have target regulation so that nothing slips between the gaps. So it's going to be a trial and testle for both the regulator, the customers, the service provider. So it's a win-win for everyone if this really comes through, and we're hoping it does. But the RBI has accepted applications, but they've still not come up with the final list of what they've approved. Apart from the very critical aspects that we just discussed, Pratibha will now also be highlighting a few more important aspects on how financial inclusion has been a very critical aspect for the government, and they're taking so many different measures to promote financial inclusion through fintech in India.
Thanks, Riya. I think we are a little running out of time. It's already 3:50, and I can see a few comments in the comment box. But let me just quickly make sure that Tushar is back online. Tushar, are you there on the audio?
I'm back, Pratibha.
Okay, great. So Tushar, we'll just take a few questions and then we can do some concluding remarks. But first question that maybe you can help answer is: do you expect valuations in fintech to fall and number of deals reduced post-COVID due to focus shifting towards health tech?
So a couple of questions here. I'll answer the first two, which is valuations falling as well as deals to fall, and I'm not sure if the connection to health tech has any connection to it. But look, clearly the risk models which we had built are going to be very, very different post-COVID. We were in the segment, for example, of risk which was largely immune to economic forces. We lend to people who make between 15,000 rupees a month in salary to about about 1 lakh rupees a month in salary, which is a broad segment. But think about people who had very transferable skill sets. People who are wait staff in a restaurant can go wait in another restaurant. Someone selling cars can sell shoes. But this crisis has impacted them the most. And therefore, we think that all the risk models we have built so far will largely have to be retested and rebuilt. So certainly from a pure business standpoint, we'll be taking very baby steps in terms of dispersing new loans. And if valuations are linked to, let's say, disposal of new loans, or the size of the loan book, or the growth of the loan book, or the quality of the loan book, which will also be impacted based on job losses, if there are job losses, if any, will certainly reflect that as well. So I think there is a new reality here, and a lot of us will have to adjust to that reality.
Absolutely. And I think it also will vary, right, Tushar, depending on business model to business model, right? So for example, insurance might go up. And as a result of that, digital insurance might go up if you have the right product and if you have the right, so it will be tier 1 versus, tier 2, tier 3, or higher income segment rather than, the lower income segment. I think you might see more pain where you're serving the underserved. But then again, the need there will be more. So, hopefully we can attract more of the impact investment into that space and more of the philanthropy into that space. So I think, post-COVID, the way the world will look like is going to vary, but definitely supply might be an issue and people might have to make selective judgments in terms of the investors, but the demand side is going to be immense, right? Like there's going to be financial pain in the economy. There's just one more question for you in terms of the alternate credit scoring system. You briefly touched upon this, how you're using technology for that. If you can elaborate a bit.
Sure. Look, I mean, the role which a number of us in this side of the equation are playing are to largely focus on either have lower costs or have some alternative source of data which can underwrite better or faster or quicker. The end result being that if you can do something cheaply, which a machine can do as opposed to a human being, those savings or that cost savings can be passed on either through a lower rate or through a product innovation, which is not currently possible by large traditional banks or NBFCs. So, for example, we lend out between 1,000 rupees to 5 lakh rupees as loans. And for 1,000 rupee loan in the best case scenario, we'll make, let's say, 100 rupees of interest over a period of time, which is typically not even enough for us to sort of move the paperwork required to make those loans profitably. Therefore, we have chosen to invest a lot in technology, but also using surrogate form the technology to aid in the underwriting decision. At the end of the day, the decision to underwrite is based on traditional free cash flow parameters, which is income, bureau score, stability, the person has a rented house or a owned house, are they married, not married, etc. But all these variables traditional typically require some money to be spent or time to be spent. So, for example, the phone, as someone else pointed out, has a wealth of information. With users' consent, we can get access to the location, which can aid us in doing KYC properly. The phone camera is a pretty good way to take a picture of a person's face as opposed to getting a passport size photograph. And then the other surrogate tools which we use to perhaps approximate income. Phone memory is a good way to perhaps use a surrogate for income. People who typically have more income will invest in more newer phones, which can help us triangulate income. Also, areas such as does someone have a presence on WhatsApp or not? I mean, if someone is digital, it'll be unlikely they will not have WhatsApp. Or if someone is working in technology services, they'll have a LinkedIn profile or not. Now, these are not variables in isolation which are enough to underwrite or decide a person's creditworthy or not. But in triangulation with other variables, it helps us determine if the person is indeed who they are claiming to be, and also their creditworthiness. So we use certainly a lot of these variables in terms of underwriting, in addition to traditional variables of free cash flow.
That's very innovative, Tushar. I need to consider what my RAM memory is. Let me just shift pace a little. There's a question on, whether we know what the developments in terms of framing the policy on digital currency is. I have on line Jaideep, who helped us get for IMAI a victory on basically getting the RBI policy in terms of a moratorium on use of digital currency with the physical payment system undone. So Jaideep, do we have you on?
Yes, hi, I'm here. Am I audible?
Yes, Jaideep. Jaideep, do you want to talk about, where we see cryptocurrencies helping with financial inclusion, and then just give an insight on if you know where we are from a regulatory perspective in terms of the policy on Bitcoins in India?
Sure. So far, there's been no official policy stance taken. There have been warnings issued by the RBI and the government, and obviously the RBI restricted buying and selling of crypto through banking channels. And the Supreme Court last month set aside that restriction of the RBI. So as of now, people are allowed to buy and sell crypto through the formal banking system and the formal payment system. The policy movements are, as of now, unclear. There is an unconfirmed report in the Bloomberg Quint that the government is considering a regulatory framework, which would seem to be in line with the Supreme Court's reiteration that proportionality is required um, uh, when any restriction is made on the freedom of trade. So, for the government to consider a ban, it may think twice because the Supreme Court set aside the RBI circular saying it was disproportionate. Having said that, it's important to note that one government, or rather two government committee reports recommended that a ban be strongly considered. So as of now, things are a little in the air. Largely, the ball is in the government's court, but the industry is free to operate according to existing guidelines till then. Quickly, just a word on financial inclusion is that the whole promise of cryptocurrency and blockchain, while they are hampered by volatility and other considerations as of now, being an early technology, the hope is that uh, the technology will be able to cut out a lot of the middlemen, which drive up costs and bring down efficiencies in the system. So if I'm able to say pay an artist in Venezuela with minimal friction, or even an artist in India in another part of the country, UPI does make that easy, but wherever there are banking costs um, and there is friction in obtaining access to the formal banking system, there are some benefits that crypto poses. A very quick example is, for instance, India is the largest recipient of migrant inward remittances, which is, I think, over 30,000 crores. And the average cost of bringing that money in is around 4 to 5%, where some cryptocurrencies promise a much lower cost. So as the technology evolves, hopefully some of these benefits can be reaped.
Thanks, Jaideep. We are at the 4 o'clock mark and we still have a lot of questions. So I'm just going to ask the administrators to extend by another half an hour. But if people need to log out, that's understandable. Let me just also bring in Mayapan, who is part of our tax team. Now, a lot of the issues that we've been talking about on the regulatory side, and specifically with respect to having the need to create a regulatory sandbox arises from the fact that we tend to be not only over-regulated. Every regulator in India acts based on their specific mandate, and we've seen a lot of that from the revenue department. So despite projects like Startup India, Digital India, working committees created to promote fintech, there needs to be a basic recognition that for fintech to help with financial inclusion, for fintech to get a more deeper penetration in India, you need the technology sector to have stable policies and for it to have access to global products, global innovative products at a cost which is comparable to the rest of the world for our startups to use them. So for the purposes of such policies, we have seen that unfortunately, not every regulator talks to each other. If MeitY comes up with something that is progressive in terms of promoting certain products in India, if revenue just increases the cost of that, the two kind of cancel each other out sometimes, or even negate it, because getting investors to invest in a country where you have a policy flip-flop becomes very difficult. Very recent example of that is the equalization levy that has been imposed on in the digital sector. So, Mayapan, are you on?
Pratibha, I'm on.
Mayapan, can you talk about very quickly just what the equalization levy is and how it affects the fintech sector?
Sure. So to give a quick background, this is a new tax that has been imposed in the recent Financial Act 2020. The interesting thing is this is not the first equalization levy. There was one imposed in 2016, but that was applicable only to advertising services. What has come into force now is much wider, and it can potentially apply to all kinds of online services provided by a non-resident to any resident in India, being a business or a consumer. So basically, it's a 2% levy that is applicable on the consideration that is received by a person who is owning or operating a platform and providing online services through it. It can apply in situations where the platform owner or the fintech operator is providing a service on a principal to principal basis, or there are models where sometimes they're acting as aggregators or facilitators. And even in that situations where services are facilitated by such platform, even in that case, a 2% levy would be applicable. Where this can actually pinch is that, like as Pratibha was saying, that this can increase the cost of conducting these operations. The 2%, it's an open question, and it depends on the model of the particular platform as to on what percentage or on what base amount of the consideration would the 2% be applicable, because it's on the gross amount paid to the e-commerce operator, as defined in the section, who we can understand as a platform owner. So there could be situations where if the platform is providing a fintech service on its own account, then it's quite clear it's on the 2% of the commission or the income earned by it, in which case also it's still an additional cost for platforms to now get used to, which wasn't there earlier. And then when it comes to, and even in those situations when we're talking about small margins and relying on large scale transactions, a 2% on the gross amount can in certain models act as a disincentive. And coming to the other model where it is a possibility that the 2% could be on the entire amount flowing through it and not just the service fees, depending on how the models are structured. In which case it could be a complete roadblock to even having that platform operate going forward in the future. So the incidence of digital taxes seem to be on the rise and seem to, in a way, take away the entire benefit of having, we've seen Tushar explain reasons why fintech operations are going up in terms of, being able to provide loans even as low as 1,000 rupees, because the transaction costs are minimized, whereas a 2% levy seems to go completely opposite to that.
Thanks, Maya. One of the questions which we have is, could you please take up the comparison of Indian regulatory environment vis-a-vis the global environment with respect to fintech at high level? So that's one of the reasons why I brought you in right now, because the equalization levy is a very good example where we are going against what the global stance on this is. Everybody is negotiating an international agreement through OECD on how you are going to deal with such taxes and ensure there's no double taxation. When India, unilaterally introduces such a tax, not only are you sending a bad message to the investors and possibly increasing the cost of doing business for startups in India, you are also possibly creating, a trade war with the countries where most of these technology companies are based, whether US or China. So I think being outliers in some of these regulations in general, we've talked about this over the course of the webinar today. Very difficult to provide a specific comparative jurisdiction because China has its own technology companies, is not that reliant on the Googles and the Amazons, for example. Whereas in India, we are more reliant and more connected to the global market. So China is not a good example to compare yourself with. I don't also want to compare myself to developed jurisdictions like EU. So for example, our proposed Data Protection Act is based on the GDPR model in EU. How does that affect fintech? As Tushar mentioned, data is an important input in terms of growing his fintech business. And when you're looking at your new act with respect to privacy, you've got to also factor in the needs of somebody like Tushar's business in terms of how you're going to provide that access to that data, not to the government, but to players like Tushar in terms of being able to then grow their businesses. So, there are so many different aspects of regulation that will touch fintech. There'll be the technology side, whether it's data privacy, whether it's digital tax, whether it's intermediary regulation. And then there's the financial regulator and their regulations, whether it's IDA, RBI, SEBI, and all of them will have to play together to ensure that we have regulations that can help grow businesses in India and not just focus on their aspect of, for example, RBI is very focused on comparison between banking and NBFCs and whether there is a regulatory arbitrage that the NBFCs are taking. However, you have to see when you have online lending through NBFCs, the micro lending that helps penetration and providing lending to a segment that otherwise does not have access to such products. How do you enable that and not worry about the regulatory arbitrage versus banks who really can't, who have so much legacy and just are not nimble enough to provide the kind of products that StashFin is providing. Let me just then quickly take on a few more questions. There's a question on how much time RBI is taking to process NBFC license. Before the COVID crisis hit us, it was anywhere between 9 to 12 months. So it is a slow process. Once we come out of the COVID situation, it's anybody's guess how much backlog we would have had by then. Tushar, next one is for you, and I will probably try and wind up after this question. So question is whether it would be balance sheet or non-balance sheet fintech players that will attract more capital from PE investors.
Okay, so I think this is a question. I'm going to frame my answers around regulation. So candidly, our views are that if you look like a duck, you quack like a duck, you are a duck. So therefore, the decision path we have chosen to be in is to be regulated and be balance sheet heavy. But we also work with a host of different lenders to have a marketplace which allows us to get leverage as well as able to get access to lower cost of financing. I think the piece which we didn't cover in the session today is that in the segment or the sector we belong to, there is a very high degree of responsibility which we need to have as well. For example, someone spoke about the credit bureau. If there was an adverse, let's say, platform or any kind of platform were to do indiscriminate lending, where they would perhaps think that charging a high rate of interest would offset for any potential losses in loans, and then go and report to the bureau if the person is unable to pay by not doing exercising proper due diligence. That adverse credit report will sit with people for their lives, right? So this is not something which should be taken lightly, in my personal view. And unlike Western geographies where you can wipe out a credit report through a process of bankruptcy, etc., those processes aren't available here. Also, for an individual to know what their own bureau score is, it's much harder than it is in the US, for example. So I personally think that having regulation is a good thing for making sure the paying field is level, and we are also a very nascent industry, so it's important that the safeguards and checks will remain in place to make sure that the customer interests are protected. But to answer your question about balance sheet or off balance sheet lending, I think it's a moot point because even the off balance sheet model which we do, there is typically some sort of loss guarantee, which would, in a way, come and bite the technology platform if there were losses which are beyond a certain threshold. So, from a ROA perspective, probably off balance sheet is better, but on a ROE perspective, return on equity, off balance sheet, on balance sheet will remain the same because of more leverage available on balance sheet.
Thanks, Tushar. There's one more for you. Do you use big data and non-linear data points to determine risk?
Yeah, that's a key part of our decision model. So clearly, in terms of the data sets we hold, we have almost 500 million, say, phone records. We would have, we'd have to do we do string matching where if someone puts a non-standard address, we have to very quickly correlate that with other addresses we may have on a borrower or even an applicant, and very quickly also determine the dupes in our own database across multiple forms of data, string, text, image, etc. So we use various forms of technology to process that very quickly. So the key is processing and storing it, and then also getting the decision very quickly, in a matter of seconds. So that's a key part of our business.
Wonderful. Thanks, Tushar. Just sorry, this is a follow-up question for you in terms of, I think they want your full business model. So literally the last question I'm going to ask you is, how do you acquire that data?
Okay, so look, we use our acquisition strategy is online and offline. We offer something equivalent to a credit card, which is not a credit card, but it's a prepaid card. And borrowers come on a platform online, and then we meet them in companies where we offer them this card for free. All the data we get is based on user consent and user permissions. Most borrowers will have to, at some point in time, download our app in order to get access to the loan status or loan application status, in which case they will give us access to this data. But we'll also use a bunch of third-party data sources, some of them which are proprietary, where we will either scrape data sources from various third-party portals or government databases as well. So that is either available on the net, or we'll scrape it, or at some point in time, we have certain type of certain companies to analyze behavior across multi-platforms.
Wonderful. Thank you, Tushar. So literally the last comment I'm going to make is on data localization. We have somebody who's just talked about how, other than the tax levies, the data localization is a big issue for the fintech industry in India. Aaron, do you want to just comment on that very quickly?
Yeah. So, this came in April, a couple of years ago, the data localization requirement. I think it's not too much of an issue. We've spoken with startups, we've spoken with the industry. The general mindset of the government is generally to localize data. We can see that with the new data protection law, which is being proposed in Parliament. Also, it doesn't seem to be too much of a cost as well. We've had this discussion with some startups and the industry. Most servers are anyway moving to India. Amazon Web Services, a lot of cloud service providers are moving to India anyway. I think certain practical issues may remain in terms of segregating data and the things like that. But I think the overall industry mindset and the government mindset is anyway to localize data, and that seems to be the trend going forward.
Thanks, Aaron. With that, I'm sorry I haven't taken a few questions, but we've run 20 minutes over time already. But if there are any specific issues you would like to discuss, please do feel free to write to us directly, to any of the panelists. On that note, let me thank everyone for such an interactive webinar, and thank you to all the panelists. And I just hope that we can get and help the government to promote businesses like Tushar's, which are really helping provide access to capital to tier 2, tier 3 cities, and to underserved consumer base. With that, thank you everyone. Have a good evening.
Thanks all.
Thank you so much for joining.
Thank you.
Thank you.